Welcome to our LLIS Insurance Academy Lite. Some of you may know that LLIS hosts our 2 days of in-person insurance steps from Clearwater Beach, Florida in February. Due to the global pandemic, we decided it would be safe to hold off this year. Instead, we planned 4 afternoons with insurance-related presentations, some from Team LLIS and some guest speakers. This presentation will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP. Please ask questions as you have them by typing them into the questions box. We'll do our best to answer them. To receive a PDF copy of this presentation, you can download the file under Handouts. Kicking off our first presentation is a regular at Team LLIS. He's knowledgeable in a wide range of solutions. He's constantly monitoring the insurance and financial services industries to ensure you and your clients are getting the most up-to-date recommendation. Here to speak on how the impact of COVID-19 insurance industry is hour.
Thank you, Claudia, and thank you for everybody for tuning in today. As Claudia said, it's different this year. A lot's been different the last year, and we our academy is no exception. And if it comes up, there we go. That was our academy last year. So it's hard to believe that just a year ago we were all getting together in person. We were all shaking hands and being in the same room together. So it's really hard to believe that that was basically almost exactly a year ago. And so hopefully this is the one and only time we'll need to do an Academy Lite like this, and next year we'll get back to in person. So lots changed in the last year. It's, I think, the understatement of the century, the millennium. But we're going to talk about some things that have changed. You know, I can go over things that have changed in my life, your life, how we do work, but at least how the insurance world has changed. And a lot of it is partly related to COVID and the pandemic. A lot of it isn't necessarily exactly, but they're changes that have happened in about the same time frame. So in the big picture, insurance companies invest premiums, collect premiums to pay out future claims. And how they do that is based on those earnings. It's what they do to invest and save to pay out those future claims. So low interest rate environment is impacting everything right now. The COVID pandemic is impacting everything right now. So it's in the low interest rate environment that may continue for a while to get the economy back up and running, may continue to be hard on insurance policies that need those interest rates to perform well. And then the pandemic is impacting how we get policies. And so we're going to talk about all of those things, because for an industry that tends to move in a pretty glacial pace, you know, the idea of electronic applications and PDFs, some companies, even a fillable PDF today is still a little too new age for them. So an industry that tends to move very slowly. We've had an awful lot of changes in the last year, and it's you know, with all those changes, there's always going to be bumps in the road, but a lot of them we hope are going to be good for the future. So we're going to talk about changes in the long-term care industry and world as a whole, changes in permanent life insurance, and especially around the MEC rules and MEC limits and how that's impacting now some older policies your clients might have and some potential benefits for policies going forward. And then underwriting, designing the policies, what policies are available. That's part of the insurance process, but then actually getting the policies issued into the clients, that's a second part or a third part of what we're going to talk about that's been impacted by COVID. So there's nothing magical about 2012, but at least this was something I found. 2012, Prudential was issuing traditional long-term care insurance policies. Many of you may not even know that Prudential ever did, but they did. So that was about 8, 9 years ago, and they had been selling individual long-term care policies, and they decided to get out. At that point in time, there still were about 50 insurance companies offering traditional long-term care policies to people. That's 50 companies in, like I said, 8 or 9 years ago. So that's sort of old history. It's a long time ago, the scope of things. 2019, now we're going back to the more recent past. 2019, MassMutual had a long-term care policy, and it was called their 500 series. Series just means sort of the pricing and benefits to a particular type of policy. And the 500 series was fairly competitive. As insurance companies repriced policies, it became more competitive, but it was fairly, it was sort of in the ballpark of other long-term care companies. And in 2019, they introduced their 600 series. This was a much higher premium policy. The nuts and bolts of it were the same, but had fewer rider options, got rid of the shared care rider, which is something I'm always a big fan of, higher premiums. So they still had a long-term care policy, just was kind of out of the ballpark. At the same time, they were offering more features and designs for whole life policies with long-term care riders and accelerated riders on their whole life policies. So it may not be a surprise when a year later they stop offering individual long-term care policies. Why? As a result of low traction with our current offering. Well, as my dad says, you can either raise the bridge or lower the river. If you design a policy that the premiums are so far out of competition, then you probably will definitely get to a point where you can say nobody's interested in it. So rather than saying maybe we're going to pull our long-term care policy, you keep having one, but the cost is so high that nobody wants it. And then a year later, you can say, hey, we let you have the long-term care policy, but nobody wanted it, so we're going to stop offering it. Again, at the same time that they were adding more benefits to life insurance policies, may not be that big of a surprise. End of last year, Transamerica stops offering individual long-term care policies. Again, not everybody may know that Transamerica had policies, but they're also, when they decided to stop doing it, had a similar future goal or plan to continue to distribute combination solutions with long-term care riders, on them. 2012, we had about 50 different long-term care insurance companies. 2021, there's about a dozen. When I say long-term care insurance companies, I don't mean with the hybrids with life with riders or annuities with riders, just pure standalone traditional long-term care policies. So we've seen the long-term care world arena, consolidating. That was from the 50 to the 12. Seen larger LTC companies buying the blocks of business from some other long-term care companies. And a big reason to it is pricing. When long-term care insurance is sort of the baby of all the different insurance options out there, and to have priced in policies originally from the 80s or 70s, long-term care or long-term interest rates were high. So interest rates, continued low interest rates, has been a problem for long-term care insurance companies. Now, what's come out of some of this? Well, hybrid long-term care solutions. And here I'm just looking at life insurance policies with traditional long-term care riders. Lincoln National was sort of the original with their MoneyGuard, and they've gone through different iterations of the MoneyGuard, but that was introduced in 1987. State Life or One America introduced a policy in 1989. Now, notice really through the 1990s, when we had grunge and Nirvana, no real innovation here. 2000s, nope, nobody was coming out with anything new. We still had lots of remember 2012, we had 50 long-term care companies. A lot of long-term care companies out there. That was what we were looking at. And we started to see this consolidation. Pacific Life introduced a life with long-term care policy in 2013. Securian / Minnesota Life came out with one in 2017, Nationwide 2019. So we have a few in the late 80s, nothing for about 20 years. And then as long-term care, traditional long-term care companies might be pulling back a little bit, the hybrid policies are coming out because insurance companies realize this is still, long-term care is still a thing we need to worry about as far as long-term care plan, as far as financial planning goes. It can be hundreds of thousands of dollars in people's later years. It can derail retirement. It can really change how we think retirement was going to go. These are big costs, so the need for it is still there. How do we, as an insurance company that maybe doesn't have a traditional long-term care policy, how do we sort of add that on to policies that we do already have, like life insurance policies? And so that's a part of where we're seeing this innovation, new policies, and partly because these companies already knew what to do with life insurance. Now we're just adding it onto a life insurance policy instead of creating a whole new animal to them like a traditional long-term care policy. Originally, single premium only. Now we're going back to the 80s. And then that's a very small subset of people who probably can write a $100,000 check, $150,000 check. Now, once you get to maybe you'll write a $10,000 check for 10 years, when you're in your later working years, your highest income right before retirement, now we're really opening up to a whole lot more people. So the insurance companies added short pay options, could go out to a 10-year premium payment. Then from 10 years, companies added a to age 65 option. Now, there can be a hybrid policy that looks like, smells like, tastes like a traditional long-term care policy with premiums to age 95. So now we have long premiums like a long-term care policy, same 4 years of benefits, 3 years of benefits, 3% inflation rider, all of these things. So now we're getting closer and closer to what a traditional long-term care premium would have been with the hybrid policies. And if anybody wants to know what a long-term care policy really does taste like, that I don't know, but I have to imagine it tastes pretty similar. So what are the benefits to the hybrid policies? Guaranteed premiums. Clients who have traditional long-term care policies of any sort of age may have had a rate increase. And like I said, when policies were priced in the 80s, interest rate assumptions were really high. And so even to say, oh, we'll be conservative and assume we'll earn 6% every year, because we're earning 12 right now. We're not at 6%. So those rate increases are happening. With the hybrid policies, that's not an issue. Premiums are guaranteed. It's also a cash value, a return of premium feature. So at some point, you can surrender the policy. Now, this would probably be the last thing you would ever want to do with these policies, because they're more valuable as time goes on. As the client gets older, the long-term care benefits are bigger, but it's there. It's just a nice knowing it's there. Death benefit, this is another pro to these policies. If I don't ever use the policy for long-term care, then my beneficiaries get back something. A lot of times it's the premium that I've paid in, sometimes it's more than that, but somebody will get something out of this. Either I'll get it as long-term care or my kids will get it as a death benefit, but either way, somebody's getting something out of the policy. A trade-off As you can imagine, the more guarantees, the more benefits you add to something is a higher premium. So you might ask, Mark, how much higher is it? Well, let's take a look at Anne here. She's 60, and so we're going to look at a traditional standalone long-term care policy, $4,500 monthly long-term care benefit, 3% inflation rider, 90-day elimination period. So for a 4-year benefit period with a traditional long-term care policy, the annual premium is just over $5,000 a year. Hybrid number 1, 4-year benefit period, $8,800 a year. Number 2, 50-month long-term care benefit, $8,100 a year. So it's not double the cost of a traditional long-term care policy. And current long-term care policies are based on lower interest rate assumptions at any point in time. They have better claims experience at any point in time. So as time goes on, the older policies issued today have a much lower likelihood of a rate increase than policies that are 5 years old and policies that were 10 years old, because insurance companies right now they have more years of claims experience, more years of claims data to price the policies on. They're pricing these policies almost with assuming people don't ever lapse them, because people hold on to these policies. They only get more valuable to them as they get older and usually unhealthier. And right now, you price with low interest rates because that's what you're assuming you're going to earn over the next however long. So pricing today is more accurate than it's ever been for traditional long-term care policies. Now, if we want to compare to all those benefits where I talked about with the hybrid policy, so almost what do we get for that extra $3,000 a year? Well, I'm paying $3,000 a year more, knowing my rates, this is exactly what it is. So rates would have to increase by $3,000 a year for me to have a long-term care policy catch up to those. But at the same time, I get those other benefits. I get a death benefit, or Anne gets a death benefit. If something happens to her and she doesn't go on claim, somebody gets $220,000 or $112,000, depending on the policy. If they decide to surrender the policy at age 85, then they get back, surprisingly, almost exactly the same amount between the two policies, $67,000, which is less than what she's paid in, but it's still something there. Those are some of the benefits to the hybrid policies that a lot of times clients are looking for. A premium's higher, but adds those benefits to them, to that coverage. Here's Michelle and John. Now they're age 60 as well. Now we're going to look at joint policies. So they're going to get a spousal discount by applying together, because over the last 20, 30, 40 years of claims experience, long-term realize that if people are together, then if one spouse goes on claim, the other spouse is likely going to care for them for a period of time. It's going to care for that first spouse for if they need just help getting in and out of bed. So all of the little things that another person in the house can do, spouses are going to do that for free for as long as they can, in general, before getting help, before the wife is not strong enough or big enough to lift the husband up from bed, or it's things like that. So long-term care companies realize that if there was just John and something happened to him with no Michelle, and he would need to start having care paid for and go on claim much faster than when there's a spouse there to help care for. Question. An example, why is the 50-month policy premium lower than the 48-month premium? Good question. It's the pricing of the policies. I think part of it is that the $8,800 policy is going to have a higher death benefit. Like at age 88, it has more life insurance than the other one. So you're balancing the long-term. They're all going to have about the same. They're all going to have the same long-term care benefits at any point in time. Number two had the higher premium because it's going to have a higher death benefit in the later ages. So good question. So for Michelle and John, if we look at a traditional long-term care policy, and this is going to be a 3 years each with a shared care rider. So 72 months shared between them, premium about $6,600 a year. Now there's an insurance company that offers a joint life insurance policy, so a second to die life insurance policy. If they never need the life insurance, then there's a $150,000 death benefit that goes to the kids, not either of them, and that's an $11,000 a year premium, $150,000 death benefit. If they decide to surrender it in 25 years, now there's $92,000 of cash value. Higher premium, a little bit less long-term care benefits, but pretty close. But we're adding in level premiums, guaranteed premiums, death benefit if we never need it, cash value if we never need it. Or we could look at two individual long-term care policies. Now here's Michelle and John, and sort of to the question I answered just a minute or two ago, their death benefit, their combined death benefit. So if Michelle and John both happen to pass away without using the long-term care benefits, there's about $350,000 of death benefit that would pass along instead of $150,000 of the joint. So higher premiums, similar long-term care benefits for all these, but more life insurance component to it is going to add to the overall premium. And there's cash values there as well. So what do I think the future is going to hold? Well, if I knew what the future was going to hold, I might not have decided to do this with these pictures because, I look pretty silly, but it was fun. So if I could predict the future, every once in a while, I think that some insurance company is going to come back in, kind of like in Willy Wonka, where Willy Wonka realized that Slugworth is trying to steal all of his candy making secrets, and so he just shuts the factory down and just waits. And then one day he turns it back on. I'm wondering if one day Prudential, as an example, using my number one, might get back in, because in 2012 they might have said, we're just not sure if we're pricing this right. They can sit back, say we have 8 or 9 years that are behind us. We're seeing what the rest of the industry is doing. And in my fairly simple idea of how it would work, they already have the computer systems to issue long-term care policies. They have the paper that would print it with the benefits. In my head, it feels like they could just switch that back on and start doing it, just upload new interest rates, new lapse assumptions, new pricing, but all the infrastructure on how to issue policies and all that would be there. So that's my, I guess, hope for the future, maybe prediction, but I think that it feels to me like there's lots of companies out there who have all that infrastructure there, just looked at the industry and said, we're not sure about the pricing. We just want to see how things go. And one day, maybe they'll turn it back on when they feel a little more comfortable. All right, so that was long-term care changes. Next, we're going to talk about permanent life insurance. So picture it. It's 1984. Crockett and Tubbs were fighting crime in Miami and redefining men's fashions. Pastel suits? Dress shoes without socks? Who knew? Prince told us that he only wanted to see us laughing in the purple rain. Alabama warned us that if we want to play in Texas, We got to have a fiddle in the band. And even though Johnny Lawrence was told to sweep the leg, Daniel LaRusso, under the tutelage of Mr. Miyagi, defeats the Cobra Kai Golden Boy at the All Valley Championship. That's what was going on in 1984. Additionally, single premium whole life was being touted as the last great tax dodge. The idea was that you could put $95,000 into a $100,000 whole life policy. There were no rules, no limits. And what you got were all the benefits of life insurance. All your gains are tax deferred. You can withdraw your cost basis income tax free. Then you can take income tax free loans against the gains. And as long as there's a dollar left in the policy, then there's tax free death benefit to the beneficiaries. All of these are the great tax benefits of life insurance because life insurance is considered a social good. It protects widows and orphans. And so it has a lot of nice features and nice tax favored benefits. But a way to get the IRS to start looking at what you're doing is to call things the last great tax dodge. So the IRS came out with 7702. It's an IRS section that defines modified endowment contracts. Basically, what it says is that life insurance, it should keep all of these benefits because it helps protect families. However, you shouldn't be allowed to put $95,000 into a $100,000 policy. That's an investment. That's retirement savings. That's not life insurance. So if you try to do that, then these become MECs or modified endowment contracts. So what that means is then if you try to take money out of a policy, then it's taxed like an annuity. But if you keep it below a certain premium, the guideline premium test, then it retains all of the good tax benefits. The idea is to prevent life insurance policies with little to no insurance. One of the issues that we're running in today is that those maximum premiums were based on the assumption that policies would be earning a minimum 4% interest rate. Now in the 1980s, when they did this, Treasury yields topped 16%. So 4%, probably everybody laughed at how low that was. You know what we're seeing today? Right now, Treasury yields about 1%. Many insurance companies' current crediting interest rates are below 4%, crediting 3.5%, 3.2%. How does this become a problem? It becomes a problem when you have premiums that are limited by a guaranteed, they're limited assuming a certain minimum interest rate that's higher than what you're actually earning. So sometimes you're getting to a point where, especially with older policies, clients didn't pay as much as they should have early years. They thought they'd just pay a little bit. Or based on a 16% interest rate, they only needed to pay $1,000 a year for life. They haven't been earning 16% for years. So the premiums are they need to increase these premiums, but sometimes they're running into problems because there's this guideline premium test that says you can only put in up to 6%, maybe 6,000 a year, but that doesn't carry it to 95 because it's based on those low interest rates. So long story short, some older policies issued in the 70s, 80s are running into some of these problems. So 7702 today, it's going to at least fix things for new policies going forward. It's going to assume a 2% minimum interest rate. So that's going to increase the non-MEC premium. So it allows for flexibility. There's just more wiggle room for policies in the future, even if someone does not increase the policies later, or increase the premiums, can wait till they increase the premiums later. If your clients have old policies, it's easier to change now than later. So again, reviewing policies sooner than later is always a good thing. Why are we looking at this? Well, I think part of it for you all and some of your clients, with the new administration, where does life insurance sometimes help out? Well, we think about it with estate taxes and seen things batted around about reducing the estate tax limits. Now, still, with 23 million right now, it's not an everybody issue, and even at 5 million, I think it would be 10 for a couple. It's still not an everybody issue. But one of the other things I've seen is getting rid of the step up in basis. And that then almost does become an everybody issue, because then anything that clients own, anything in a brokerage account or what have you, wouldn't get the step up in basis at death. And so life insurance is one of those few things that will pass income tax free. So this becomes an everyone issue. So what does 7702 have to do with this? The higher premium you can put into a policy, or phrased a different way, for X premium dollars, it will allow you to have a lower amount of life insurance. So you'll have lower costs of insurance. So you're going to be able to have that life insurance wrapper for lower expenses. So allow the same tax deferred accumulation and tax-free death benefit. So here's Steve, he's age 60, standard rates. He wanted to look at passing on $100,000 into a life insurance policy, but we don't want to make it a MEC or modified endowment contract because he might want to use this money. The idea is I want to pass it on, but I don't want to truly give it away. And so I want to, if I need to take it out, I want to be able to do that, not have any tax consequences. So we're going to look at an accumulation type policy. So here, just sake of argument, I assumed a 6% rate of return on investments and a 25 basis point expenses. So a 5.75% after expenses. After 7 years, potentially, and this is using very simple math, he'd have $129,000. Now, the $29,000 is gains. If that all passed to the kids because there's no step up in basis, the kids would net $125,000. If it was in the life insurance policy, they would have gotten the $222,000 death benefit, and that would have been income tax free. At age 80, the investments, his $100,000 in investments grew to $268,000 after taxes. $243,000 passes to the kids. With the life insurance, it still wins $251,000 income tax free. Now, at some point in time, the costs on the insurance policy are going to, they're always a drag on the investment part. So insurance is always going to win if there's not enough time. Investments are almost always going to win if you have enough time. And so that's what we see here. In the short term, the life insurance death benefit, because it's higher than the cash values, wins. As he gets to be age 85 or 90, well, assuming the investments all did well, even after taxes, it's going to be higher, because we have those insurance costs of insurance and the drag on that investment performance. So what does the future hold? Again, look at those pictures. What a handsome devil. Well, with the new modified endowment contracts, the new MEC rules, it's going to allow for larger premiums, or flip it on its head, lower face amounts. So in my example, Steve's life insurance death benefit early on would have been lower. So maybe $200,000. Still tax-free, so that's good. Still would have outperformed the investments. And at some point in time, you'll have a growing life insurance amount, you have the growing investment amount, And conceivably, the tax-free death benefit may win out to age 85 instead of 80, because we don't have to have as much life insurance initially, and so that tax-free wrapper becomes more beneficial. And what it does is when we minimize the insurance charges, we're maximizing the earnings in the policy. Brings those numbers closer. Like I said, the initial death benefit instead of 220 might be 200, but we have lower insurance charges every year, and so it's going to outperform better. So my hope is that in that scenario, then the tax-free death benefit is going to win to an older age, meaning that that tax-free death benefit amount looks more attractive to older ages because we have less insurance charges. So the investment or earnings net after the insurance charges is going to be higher. All right, the last section we're going to talk about, the COVID underwriting changes, and there's been a lot of them. I said it before, but for an industry that tends to move very slowly, there's been a lot in the last 12 months. And there's been new programs and insurance companies that had existing programs really ramped up, increased limits. So it's been a very interesting, sometimes confusing, every once in a while frustrating, but very interesting last 12 months. So underwriting in the time of COVID, what does it look like? Well, everybody wants speed. I think even more than a year ago or 2 years ago. I think we're all more reliant on Amazon Prime to get us our stuff. Walmart now has free shipping over certain amounts. Target has that, and it all tends to be pretty quick. I think we're all just getting more and more used to that, and so the whole idea that a life insurance policy can take 2 to 3 months, it just feels like that's just too long to sometimes. And this is a big one. People, less now than say 6 months ago, but for a long time, most people didn't want to have a paramed exam. Didn't want necessarily a stranger to come into their house and take a blood and urine sample. Didn't want to go to the local facility and go, give a blood sample and urine sample. So that was a big thing that people really didn't want to do. And we were being told, stay in our bubbles, don't do that sort of thing. So that was tricky. It was insurance companies, for the most part, like paramed exams because they're going to give them a really good snapshot of that person at that point in time. So how do we balance that with people not wanting exams and insurance companies still being able to issue policies? I talked with somebody at an insurance company this morning, and I think he said that 97% of their 10,000 plus people are still working from home. That's an insurance company. So when you have all of a sudden all of these people working from home, you need to find ways to make things easier and simpler because we don't have access to everything that we did in the office. So insurance companies are trying to make it easier for the applicants, but also easier for their people. And then there's the whole idea of COVID and the mortality assumptions built into it. And again, that's still a big unknown. We know a lot more in the short term, but I don't think anybody knows long term what issues there may or may not be. And So that's something that gets adjusted almost weekly. Some insurance company is going to say we were doing this and now we're doing that. Foreign travel right now is a big surprise. Sometimes the same insurance company that might have issued to people who might have had foreign travel coming up soon now say they won't. So foreign travel is just almost on a day-to-day, case-by-case basis of which insurance companies are going to offer coverage. In general, a lot of them lowered their maximum issue ages. A lot of insurance companies would issue life insurance policy to people in their 80s. That's pretty rare anymore. Also looking at comorbid conditions for people with asthma, emphysema, any sort of respiratory issues. They're looking at that and saying if that person got COVID, they're probably going to have a harder time than somebody who doesn't. Doesn't mean that they will, but just very likely that they might. So some of those things are all coming into play in the underwriting guidelines, and they're sort of like a whipsaw sometime. Right now, nothing. Right now, everything. Okay, maybe at some point we end up back in the middle. So a lot of insurance companies try to have some form of accelerated underwriting. And when I think of accelerated, I really mean people not having to have lab work. If I apply for insurance and an insurance company wants to get my medical records, that's great. That can be going on in the background. It doesn't really concern me. It's not really bothering me much. But if you tell me somebody's got to come out and stick a needle in your arm to draw some blood, I say, ooh, that's sort of a big deal. So when I talk about accelerated underwriting, I'm talking about not having to have lab work. Mid-COVID, one insurance company said, well, we guarantee no lab work for applications, people $500,000 between age 20 to 50. It's not guaranteed issue. You still have to get underwriting, and they'll order your medical records and do lots of things, look at your application, but they're going to make an offer or decline you, but make an offer without lab work. And so that was something that a lot of people were interested in. Company B does what the majority of insurance companies do. Between certain ages and certain amounts, we're going to try to make an offer, try to get you through underwriting without having an exam. So we're going to look at the application. They're going to order your motor vehicle history, your prescription database history, the MIB, to see if you applied other places in the past, have you been declined before. More than likely, they're going to order your medical records. And so with this company, they're looking to say, if you've gone to the doctor the last 24 months, had lab work, had a physical, and we can see your cholesterol, see your blood pressure, see all these things. Now, your doctor's not testing for nicotine, and the insurance companies would really like to know if you're a smoker or not, but they're trying to do all of these things to say, I have enough information to make an offer without having to have new labs. And if you're up to age 40, we can do $2.5 million. Between age 41 and 50, it's $2 million. After 50, well, we're going to need an exam because we just want to see how things are. Company C, similar to that, except they said maybe we'll do up to $5 million. So, these are just neat things the insurance companies were doing, but B and C retain the right to have the exam. So their pricing isn't different than it was before because they always retain the right to do the exam. Company A, their pricing is always going to be a little bit higher than probably somewhere between number 3 or number 4, because they have to build in the fact that they might miss something somewhere. And somebody says, any company's lab free above age 50. Hold on one second. It's like you knew where I was going. 2021, Company A, the end of last year, increased their lab free to 750,000 and up to age 60. Company B increase their limits from 3 million to 3 million and 2.5. Company C up to 7.5 million, and I believe they're also up to age 60. So yes, the insurance companies expanded this. Definitely some have over age 50. I believe 60 is the maximum that anyone will go without an exam. But just neat things that as time goes on, they have the experience, they see how it works, then they can expand those things a little bit. Other insurance companies who didn't have an accelerated underwriting as of a year and a half ago have introduced them. Most did. So what we've seen most is increasing their limits. Some have kept to $1 million, and are very happy at their and are just sitting there. A number of other companies have gone and said, we started off at $1 million, we'll go to 2. Or we started off at $1 million, we can go to 3. We retain the right to order an exam, so it doesn't really hurt them. They're looking to see, do I have enough information that I can make a good offer? And if I don't, I can still have the client have an exam. But the first thing we have to do is the insurance company has to review the application. As part of in order to be eligible for the accelerated underwriting process, you have to go through a certain process. And that usually involves us contacting the insurance company, giving some information about the client, but then the insurance company or an exam company is going to reach out to the applicant and traditionally do a phone interview. And that can be with the underwriter calling the client, that can be somebody from the exam company doing it, but it was all done by phone. And really what the person on the other end of the line was doing was asking basically the application questions. And if a client said yes to something, then there'd be some drop-down boxes that they'd fill in. Well, as you can imagine, if you've ever gone to a doctor, the only time you're probably going to be on time is if you're the first person, and even then probably not. If you're the last person, then you know that every person who went late by 5 minutes or 10 minutes, then you're 45 minutes late for your appointment later. That was sometimes happening with the phone calls. People were running late. You might have been scheduled for 4 o'clock. You may not have gotten called till 4:30. So it was timing. It was a timing issue. So insurance companies realized, some did, to say, all we're doing is just having a person ask these online questions. Why don't we just have the client answer the online questions? And so they've skipped that part. Saves time, not having a phone interview do it. Clients can do it at 10 o'clock at night as compared to a phone interview that normally you'd have to schedule during the day, usually during work hours. So that's been a big change that we've seen. E-medical records. This is, I think, a big one. And Jenny's going to talk about this on Wednesday, but just the idea of how insurance companies get medical records. It's a long process. It's a multi-week process most of the time. So Human API is sort of the main company who's doing this, creating medical record links or online links between insurance company and a client's online medical records. So it's a secure link where the underwriter can go and review those medical records. So what can happen is an underwriter can be looking at records in a matter of minutes as compared to waiting weeks for copy services and all of those things that Jenny will talk about to get from insurance company to the doctor back to the insurance company. So if you can reduce how long this takes, then that means we're reducing the amount of time a policy takes. And this again was something that I remember starting to be discussed and talked about end of 2019, although this would be a neat thing. When doctors' offices shut down, when copy services were not able to have as many people in the office, this created a giant backlog. So this became super valuable to all the insurance companies. I just like this slide because it shows that why now? Well, 96% of healthcare providers have some kind of electronic health record plan. This wouldn't have made sense 10 years ago because a lot of doctors' offices didn't have online portals. But 55% of right now of patients actively use it. So when you're almost at 100% of doctors having online records, now being able to set up these links is practical. So what are the cost savings? Big. There's lots of, right now, there's multiple steps, multiple people who charge for all of these things. With the human API, besides the cost of just having, I guess, a software subscription, I don't know how they do it, but it should be a lot less. And to the insurance company, if we're saving on paying for, remember, they collect a premium, pay for all of these things, and then issue a policy. If they can say, we're saving money on all of the records, maybe we don't have to get an exam. Maybe we got all these records easier, faster, and we can see everything, and we know that they're complete. Maybe this person is more likely to not have an exam. And maybe it can move more people through accelerated underwriting. Where I want to see the future here is the more efficient accelerated underwriting. And I don't think, unlike some of my others that are a little more, maybe a little more out there, I think this one is very doable. So we know one insurance company who says in 2020, their goal, and they about hit it, was to have about 1/3 of people who were eligible for the accelerated underwriting to go through the process. This year, they're hoping to be somewhere between 40 and 50%. It doesn't necessarily seem like a big jump, but from an insurance company, if you would have asked them 4 years ago that you're going to have half of your applicants not have exams, they probably would have laughed, and somebody would have hurt themselves because they were laughing so hard. So to say that last year we were at 1/3 and this year we're trying to get even better than that is pretty, it's lightning speed for insurance companies. And I think how they're going to be able to do that is with things like human API, where underwriters will get the application, do the big data checks like the prescription database, get clients' medical records first, because I think historically it's been, let's get the exam, see what they look like, and then order medical records if we need to. I think now ordering records may be cheaper and faster and maybe even more complete, and that may be able to get people get through more people without exams. Maybe there's going to be another no exam company. I like my first one better than my second one for prognostications over time, especially because most clients still opt for price over an exam. I thought for sure when anyone sees that the no exam option is $660 and a traditional policy is $610 or $620, that everyone would be picking the no exam option, and most people still are going for lowest cost. It will be interesting to see if somebody can get to $1 million, because a lot of your clients, 750 and below, it takes a lot of them, a lot of your clients need $1 million of coverage. So it'd be interesting to see if they can get to $1 million, what people choose. But right now, some people are still saying, let's not do the exam, but it's not as many as I thought it would be. At policy issue time, this one's new, really just because COVID can be fast occurring. Insurance companies want a good health statement at the time of policy issue to say nothing's changed since you applied, you haven't gotten COVID since you started the process, and now it's time to approve. If they do, it's really not that big of a deal, at least as far as the underwriter goes. They're just going to postpone it 30 days and review based on severity when somebody's who's pretty much been cleared for 30 days. Disability underwriting changes. Similar to life insurance, but different. Pre-COVID, there were limits, age 50, $6,000 a month, where the insurance company would say, we're going to order medical records, try not to have exams. Right, sort of mid-COVID, June, July, there was no maximum age, $10,000 a month. So it was pretty wide open. But disability companies are looking at chronic issues. They're able, probably better better served by getting medical records to see, has someone been complaining about something for a while, or being treated for something for a while, rather than an exam, which might tell somebody if their cholesterol is a little high. So DI companies are looking for those chronic things. Where life insurance, I think, has increased and gone to these 2 million, 3 million limits, and I don't think they're going to come back. Disability sort of started low, went high, and then it's kind of settled in the middle. They brought back the maximum issue age of 50. Didn't want to still go to age potentially 62, 63, but kept the $10,000 per month. So like the disability buyout, not the 360 that it was, not the million that it was, but 750, kind of in the middle. So that's, that's a nice plus going forward, is that having those higher limits for clients to have that possible no exam option. At policy issue time, disability companies are keyed into this because people's jobs have changed. They're asking, now that the policy is about ready to be issued, have you had any reduced hours? Or is there a reason to think that you're not making as much now as time to issue the policy as when we applied? Because if they do, then they may need to go back and revise the amount of coverage somebody's eligible for. Or they're only working 15 hours a week now instead of 40, unfortunately may not be eligible for coverage at all. So they're looking at that at this point, right when it's time to be issued, to make sure that policies are covering the amount of income that that client is expected to earn. So we talked about changes in long-term care, changes in permanent insurance, COVID underwriting, and I have a few questions that came along here, and I'm going to see if I can flip through these here really quickly. I got that. And some of these look like they may be longer than I have time for here, and so I will definitely follow up with you later. Let's see, did the life insurance example include commissions? What amount? I have a client with a GVUL. So in my life insurance example, that was just the death benefit. So that was just the death benefit. It didn't. It was just whatever the death benefit was. So any charges, any of expenses would have already been built into that. Maybe I didn't answer the question, and so I'll follow up with you separately. A few other questions that I will follow up later. And thank you everybody for tuning in. We have 3 more Academy presentations the next 3 days. And so we'll have Bob Herman tomorrow, and Jenny Stiles on Wednesday, and Debbie Miner on Thursday to talk about annuities. And I say, see you soon. Hopefully this will be all of you a year from now. It'll be all of us a year from now, back on the sand with that beach. It's not photoshopped. It really does look like that. So I really hope to see all of you again in person soon. And thank you all for tuning in. And I hope everybody has a great rest of your day. Thank you.